I am Puneet Khurana with my very good friend Manish Dhawan, and together we bring you Stoic Podcast Series. This series is started as an initiative by StoicInvesting.com to bring the best minds of investing to teach their wisdom, irrespective of their investment style or philosophy. Learn the various viewpoints, choose the nuggets, and then develop or enhance your own investing style.
Hello, listeners. What's up? Now, before I begin today, I would like to take this opportunity to thank you guys, the regular listeners of the podcast. Well, this podcast series we started with an objective of some myth busting and some practical learnings. The attitude of modern day journalism, with extremely few exceptions, is to chase the success stories. They do that to provide the audience with some dopamine kicks of sensationalism, but the process of success is anything but sensational. I have been an investor and a money manager for long, but I also wear the hat of an educator. And I started this series so that I can clutter through the noise of the hypocrisy of the investment world, but simultaneously also bring about some specifics to the general investment yarn that is thrown around in the world. Well, objective is very simple. I keep my students and the listeners of the podcast in my mind, and most of my questions are generally from the point of view of what specific learning I can bring about in the podcast which can benefit them. I'm happy that you guys have found many useful and practically applicable learnings, and I thank you for all the appreciation that you give us. With that, I would like to now introduce our guest for today. Well, in the Indian markets, he really needs no introduction. He is someone you will definitely have some point of view on, love him or hate him, but he is not someone you can ignore. A sharp research mind and an acute investor who, along with his wife, created an organization that did rattle many cages. They have struggled for their business and their freedom in many well-documented battles. Friends, we have with us Shankar Sharma, the co-founder of First Global, the firm that he created with his wife Devina. But that's not all though. Today is another unusual thing about our podcast. Well, instead of the usual setting of one co-host, today I have two. My dear friends Manish Dhawan of Mystic Wealth and Nuresh Mirani of Analyse India. Both were the part of this conversation. All three of us enjoyed this conversation with the so-called Perma Bear of the Indian market. Yes, I asked him about that too, but for that, just hold on. So join us in our conversation with Shankar Sharma. Welcome to the show, sir. It's a privilege to be talking to you, and I think I can say for all of us that we are great fans, specifically for the kind of investing which you have been doing over a period of time, and your, well, let's say, no BS views on the market almost all the time whenever we hear you. So,
Sure.
so
No, thanks very much. I look forward to having a good interactive chat with you guys. Thanks for having me.
Great, my pleasure. One of the things which we try to do in our podcast is that we tend to not talk about your current views on markets and all that kind of questions, because we're not a TV channel. So we'll keep the questions to the philosophies and everything else.
Yeah, I'm so glad you say that. The usual day-to-day thing is too boring, and that's really and that doesn't have much intellect behind it, anyways. I'm glad we are going to stay away from that.
Hopefully, intellectually, we'll be able to ask you better questions. So let's start.
Sure. Let's go.
Sure, Mr. Sharma. I just, want to pick your brains on the latest interview that you just did. I heard you recently said that luck plays a key role in investments, and almost 80 to 90% of your success, but only 10% can be attributed to skill. Now, but that 10% is important to get the benefit of 90%. Can you tell us what, as per you, is that 10% component? What is the skill set you think an investor should have before he can utilize his 90% luck?
Okay, I mean, the thing about investing is it's not very difficult in reality. It is made out to be a very difficult thing, but if you cut to the chase, it comes down to very simple things. Everybody from, I think, BCom first year knows what is return on net worth. Everybody knows what is the meaning of return on capital. It is simply that over a period of time, and this is from our own personal experience, that we kind of forget all these things and we go into a lot of minutiae, which is, management quality, and this CEO is a visionary, and they have a great business model. I mean, all those things are ancillary. The central point is very simply that it comes down to return on capital and cash flow, long and short of it. Okay, in some cases you're able to see that today. For instance, if you go back to the 90s, the multinational companies were prime examples of companies with high ROE, ROC, and high cash flows. Okay, while Indian companies almost uniformly never had cash flows, at least back in the 90s, because having cash flow was not considered to be a significant metric by which managements evaluated themselves. So anybody who bought a basket of high cash flow and high ROE companies in the 90s, I'm talking about the Nestle's and the Levers and the Castrol's and something like 10, 15 other names, without using much skill, if you just went by that simple metric. And the fact is that they were not cheap, which is, in fact, I must confess that we never liked them, to be honest with you, back then, because they were all 60, 80 times earnings. But anybody who said that, no, I'm just going to buy high quality companies, which is defined as high cash flow and high ROE, ROC, ended up, making a lot of money without getting into figuring out, RBI's monetary policy stance or the government fiscal policy stance or the US Fed policy. None of that actually mattered. Through a cycle of 10 years, I'm sure the basket would have compounded, 30, 35%. So it comes down to pretty simple things most of the time. So in my experience, over 20, in fact, longer than about probably 30 years now, I have seen that for large parts of a market cycle, investing is pretty simple. Okay. And that is the 10%. So you basically go in, you buy what you're comfortable buying. I mean, many people are not comfortable buying bad companies. You have to invest as per whatever your mindset is. But if you do that consistently, the 10% is almost a given. Almost a given. Where we go wrong is when we end up trying to be too cute and trying to, do things which is against our grain.
Right.
By and large, I have found that 10% is not rocket science. That said, the 90%, which I'm sure we'll talk about it, but 90% is required because in many, many, many cases, you have no idea, management has no idea how big those stories are going to become.
Right.
Okay, so that's where the luck element comes in, but we'll talk about that later.
Sure. So the 10% which you are mentioning about the skill set, I think what you're eventually saying is that the skill set also will solely depend on the individual, what he's comfortable in doing and what he's not.
Absolutely.
And
Absolutely.
What you just mentioned, that buying the basket of great companies, well, great in hindsight also, but even by the basic parameters, if you would have bought the basket, would have done well. Just to get to your style of investing, which we have observed over a period of time, also you have been vocal about it. You said that people look at momentum, 52-week highs. Apparently you look at negative momentum, a stock in downtrend for years. Well, it sounds fascinating. It's contrary to what that thing which you just said, but I think that's your style. Is that it?
Well, actually, momentum is very central to our style, whether negative or positive. And you can play momentum both ways. So you can play positive momentum, the stock is successively making highs and you're long that stock, which is basically also defined, if you look at it on an overall basis, relative strength. So if you're buying strength, by and large, again, that's plenty of studies out there that you will do pretty okay. Again, there are simplified models of investing and they work actually quite well. That if you bought the best performing basket of stocks in the previous year, in all likelihood, they will almost always remain the same.
Yeah.
A few might drop out. Okay, that's okay. But as a basket, if you bought the top 10 or top 15% of the market in terms of outperformance, I think you will be okay. So that is one approach, and we do employ that approach. It's not to say that we don't like positive momentum. Okay, because those are actually easier than the negative momentum trades.
Okay.
The negative momentum part is also interesting for us because it is also about a little bit of a challenge. It's a little bit of a thrill.
Okay.
It is like trying to attain the unattainable. Okay, so in a sense, if investing becomes too easy, then you say, come on. This is just like driving a car or riding a bike. What's the big deal in this? And frankly, there is no big deal in it. Just to make it very clear, I think it's an overrated skill in any case.
Sure.
So the negative momentum part also comes out of the fact that, look, I am going to do something. I'm going to go out of my comfort zone and then prove to myself that I could bat on a tough track instead of batting on a feather bed, if you take a cricket analogy.
Right.
So the value of those runs is a lot more satisfying than the value of runs made against the mediocre opposition. Mediocre opposition is high momentum trades which are continuing for years. So buying HDFC or HDFC Bank or Hindustan Lever, that's okay for 20%, but that doesn't get us out of bed every morning.
Okay. So how much of your portfolio will keep for thrill seeking and how much for, and I'm not saying thrill seeking just for, you obviously would make profits in that. That's why you will continue with that. But how would you divide your portfolio? Do you divide your portfolio first of all, or is it as and when it comes?
Yes and no. It depends on the situation in the market. In a sort of trending bull market, then it becomes a very different portfolio, because then you're long. Obviously the positive momentum.
Right.
In a bear market or a bear market, even not even on an overall basis, but bear market for a sector. Okay, that is when these kind of trades start to build up. And I'm not saying thrill seeking should be the reason why you should be in the market. All I'm saying is, I don't want to convey the wrong message. All I'm saying is that in whatever you do, being in the comfort zone will give you a certain normalized return over a period of time.
Sure.
Being out of your comfort zone, then that's, as equity investors, we get paid to take risk. That is the reason why we are doing equities and we are not doing all other kinds of investing. That is central to being an equity investor, that we take risk. Right. So to take that, this is consistent with that I want to take a bit more risk at certain points of a market or a sector cycle. I'm not comfortable just being a safe investor and playing, very straight back shots. Right. So it is coming not just out of thrill seeking, it's simply out of the fact that you're seeing opportunities. There is danger in them, there is risk in them, but it is if your analysis and your or all parameters you look for in such situations, they all get checked, all the boxes get checked, then you have to do that trade. So right. I'm just clarifying. Okay, so it's not just about it's not a wild ride that one is entering. So to answer your question, there is no real hard and fast division between the high risk and the relatively low risk trade. But if I were to look at portfolios, I think it's largely high risk.
Okay.
It just happens to be so. I don't think it is coming out of a very hard line. But that's a bit. It's probably 60-70% might be the relatively higher risk bets.
And just to fill the gap there, when you say high risk, what are you implying there? You are implying the negative momentum?
What I'm implying there is that street view is negative. Consensus is very, very negative. Numbers are looking terrible. But something is in the works which convinces us that this could be the trade where you can make 5 or 10x.
So perception risk you're talking about.
It's a perception risk. It's a management quality risk. People might say this is a trash management, or this is unethical management, or whatever it is. People have a lot of stories about every company.
Right.
Mr. Sharma, when we are playing the momentum on the positive side, let's say 52-week highs, I have a feeling that the risk management is rather easy and straightforward. Whereas when you're seeking negative momentum and literally catching a falling knife, it gets a touch difficult. I really wanted to understand your risk management style when you do that. What percentage of your corpus would you bet on it? And when do you know that it's time to pack bags?
Okay, I'm not into catching a falling knife, just to be clear. Okay, all the negative momentum trades over literally 2 decades that one would have liked and one has liked and one has made money in have all been gradual, sort of, they're not even falling, they're like balloons drifting down, let's put it this way. So they are like in a gentle drift, they are hugging the bottom for like literally for a year, 2 years, 3 years. Those are the trades that we talk about as negative momentum. It will never be a sharp fall, or almost never be a sharp fall which has happened like today, and we are into the trade tomorrow. That is unlikely to happen, unless there is a trade like oil which happened last year, where for a year or so, but even then it was roughly a year that oil had been in a bear market, because the collapse started in, I think, the end of 2014.
Right.
And it was in a bear market for like pretty much the entire 2015, and then the bull market started in February 2016. So that's when we got interested. So it still has to spend time at the bottom. It will never ever be a straight vertical fall and then we are into the trade and we have made a quick 20%. That's not what we do from an investing angle. From a trade angle, that might happen, but that's a different part of the strategy completely.
Sure.
Got it.
So
what
it is more a longer term, 2-3 year kind of bear market in a stock or a sector that we are interested in.
Interesting. And how much do you buy? Do you go all out at one go, or do you build your position in such a scenario?
We will build our position, but typically in a stock, and remember, all these companies will end up with very small market caps in any case, because they are, they've obviously collapsed a lot. Okay, so we will never actually put in a lot of capital, because a lot of capital it cannot simply take. There's not enough liquidity, available to take advantage of that. So I don't think you can buy more than 5-10% of those companies in any case at the best. And usually all these companies, will have situations where you actually don't need to put a lot of absolute capital to risk, because you're looking at that 20x, remember, 10x, 20x over a 2-3 year period. So you don't need to actually put in 500 crores in them. You can put in 50 and
sure.
You're going to make 10x of that in 3 years' time. That's not bad return. So you see, it is actually relative to the size of your overall investment portfolio. You're not risking a lot. It's simply that they are so damn cheap that, if you're putting in 25-50 crores, you're down 20%. Also, it is not going to bust your bank or bust your balance sheet. And relative to whatever size you're putting in, if you're playing with, 1 crore and you're putting in 5 lakh rupees into those trades, you can't lose much, right? At the worst, they will, stick around there. So, you're not really in absolute terms, you're not risking a lot. And that's why I like that strategy.
Oh, okay. So, you in middle of your answer, you said a line which I want to probably pick on. You said that you're looking for a 20x trade in, let's say, a 2-3 year time period, right? And that is possible when you are trying to find the companies which you are finding. Does timing becomes a very important part there? Because cheaper companies and cheaper sectors, if I, let's say, have to pick one, let's say a capital goods or something like that, and if it's not doing well for 3 years, what makes sure that it is, are you driving your point by data? What is it that you're looking for the turnaround to happen?
Usually it is, you will find enough catalysts out there. So usually it will be at least 1 quarter of good numbers.
Okay.
Which are surprises, which are absolute surprises.
Across the board?
Okay. In that sector. Usually these trades work the best on a sectoral basis.
Sure.
And usually we try and do a sector bet than a stock bet, because stock risk, there are so many elements to it which are very hard to model and predict. Okay. And a stock can go to zero, but a sector cannot go to zero.
Sure.
No matter what the problems in the sector are, they will still remain with a certain positive market cap. A stock without, a Worldcom can go to zero, or Enron can go to zero. But as a sector, sectors don't go to zero. So our risk is a lot lower in buying beaten down sectors.
Okay.
So, it's more a sector bet, first of all. Second, when we are looking at these situations, usually 1 quarter of good numbers is definitely what we look for sure. Okay. So we don't want to be too early in the trade. We want to actually buy 20-30% more expensive. That's no problem.
Okay.
Because usually when beaten down sectors deliver a good set of numbers for a certain quarter, stocks will pop for sure.
Sure.
Okay. And then one is already they're on the radar. One is watching for some catalyst. A good set of numbers is a very good indicator. Then one is going deeper. One is talking to management. One is talking to people in that overall industry, whether it's an industry expert or whatever it is. Mm-hmm. And you then understand quite quickly that this looks to have some sustainability. It's not just a flash in the pan. And remember, for a single company, a flash in the pan is possible. For a sector, flash in the pan is usually something to be paid a lot of attention to.
Sure. And so when you're just buying this as a sector, I completely buy your point that if one sector across the board the results are good, the chances are that the sector is going through a positive side. Once in a while, however, there could be intermediate triggers which are not sustainable triggers. In that case, your risk management. What exactly is your risk management? Is it time-driven risk management? Is it price-driven risk management? Or is it value-driven risk management? So what I'm trying to ask is, will you sell, for example, okay, I have waited for 2 years and the trigger is not coming, let me sell it. Or it has fallen this much from our buying price, let us sell it. So what is it that your selling point on the negative side and not on the positive side?
Selling point is simply that our thesis isn't working out. The stock price may or may not work. That's okay.
Okay.
Because stocks don't necessarily always follow fundamentals. And particularly in beaten down names, people are so negative that they can even ignore a good set of numbers. It can happen.
Sure.
Okay? Because, market needs more confirmation for names that they don't like. So the stock price itself doesn't matter. But if your thesis isn't working out, if what your original reason for buy was is simply not there anymore, that's the time to exit. Even if it's the same stock price, even if it's a 20% higher stock price, even if it's 30% lower stock price, it's more that, look, boss, we thought this is the way it would pan out, but the sector isn't behaving well, or the company management doesn't seem to be good, or whatever. There can be a number of reasons, but, we are wrong on this, and let's just simply get out of it.
Okay.
And as I said, therefore, that the trade sizing is very important. So you cannot be disproportionate to the free float of these companies, because almost all of these companies become more like VC investing. So they're illiquid, hard to get in, hard to get out. So you have to size your trades very carefully here.
So can you give a brief as to how do you size your trades, industry wise as well as company wise?
Like I said, not more than 5-10% of the company at the highest.
Okay. Industry wise.
And industry wise, you multiply that. Most industries will have at least 5-7 names in them.
Oh wow.
Usually, by and large.
Okay.
So you are then deploying not more than, depending on this level of conviction, you're deploying not more than 25% of your risk capital into that particular sectoral bet.
Mm-hmm.
Not more than that.
Okay.
And like I said, given the upside if things pan out, you're talking significant numbers. So there's no point being so greedy at the bottom that you've really gone out on a limb and tested all your risk parameters and bought so much that you can't exit. All those things are quite a stupid thing to do, because you're looking at 10x. Why to risk so much in the beginning itself?
Okay.
I'll give you a simple example. We bought into a company called A2Z Infra about a year back.
Sure.
A year and a half back.
Yeah.
Okay, about 20 rupees. It's about 40 rupees now. No, I think I own maybe 8-10% of the company, something like that.
Sure.
Now, if you look at it, the daily trading volumes are about 10-20 lakh shares. Okay. And at that volume, you can assume that exit is maybe a 30-day period. Okay. Forgetting the price for a second. All right.
Sure.
Now, that is comfortable. But if you were holding 25% of that, that's a strict no-no. That's no way. No matter how convinced we are, that's simply not going to happen. Okay. So, that's a good live example of the way you would want to size it.
Let me go, the next level within the stock selection also. Okay. So you decided that an industry is ripe for, let's say, a comeback or whatever it is that you're betting on. Generally, we have seen in that, especially in the cyclical sectors, we have seen that at the time when the sector turns out, the quality of the management really doesn't matter. On the contrary, sometimes the really bad stocks will give you outsized returns, and the good companies in that sector might give you lesser returns. What is your security selection criteria within that industry once you find one?
Actually, the worse the stock, the better the return.
Yeah, that's what I wanted to ask.
So definitely, if you are going to be positive infra, you're not going to be buying Larsen and Toubro.
Yeah,
let's be very clear.
Yeah.
If you look at and that's where our focus on sectoral weights, because that is very central to our investment philosophy, is look at the sector weight.
Okay.
And when the sector is going to turn, then the guys with the lowest weight in the sector is where you will make the biggest bang for the buck. Because look, a weight of a sector is always bounded by 100%. Correct?
Right.
So if there are 10 stocks in the sector, Larsen and Toubro, let's say 30%, and the others are like 5%, something is 15%, etc., etc., etc. And then you will find a bunch of stocks with like 2% sector weight, 3% sector weight. Okay. And they used to be 10% sector weight 5 years back. So when they're at all-time low sector weights relative to their own history, okay, and you are then finding some catalyst within the overall sector to turn positive in, those are the names you're going to be buying, the ones who have lost 90% of their weight in the last 5 years or 4 years or 3 years, whatever the time period is.
Fair enough.
Because those from a 2% weight will go to 4% weight or a 5% weight, but Larsen and Toubro from a 30% weight is probably going to lose weight to these guys. Because weight is always a circular move between the low to the high, high to the low.
Right. Is there a criteria I'm saying? So let's say, is there something which will say, okay, even though this company is like really low, but I don't want to touch this company. What will stop you from touching that lower weight company? Let me ask that.
Like I said, the first point is whether we are seeing enough to turn positive on the sector itself.
Yeah.
If one is, then you have plenty of guys, the fallen angels, who have lost 80-90% weight in the last several years' time. And then it's a pretty simple thing to pick that, usually companies with those kind of weights and that bottom will have debt. I mean, that's almost inevitable.
Yeah.
Okay.
Yeah.
So then you pick the least worst option out of them. I mean, it's a dog with the least fleas.
Yeah. So I'll let me talk in terms of examples. I probably will put across question better. So let's say if you're picking Infra, okay, and you see a Madhukorn project but some very high debt to equity number, and the balance sheet, let's say a company is, let's say 10x, 10 debt to equity, okay, and the balance sheet is screwed up, and cash, of course, no cash flow from operation, nothing which an investor looks for, okay, and then there is something which is 5x, and you're saying, okay, I want to touch these bad companies, both are bad, but will you take 5x or will you take 10x? And in the upcycle, it wouldn't matter because none of the companies going to get bankrupt. If they haven't gone bankrupt in the down cycle, they won't probably get bankrupt in the upcycle.
Correct.
So what will you pick?
So again, remember one simple thing. That the criteria is never that simple that just because the company is in trouble, I have to go and buy it.
Yeah,
okay, so
that's what I'm trying to ask. What are those criteria?
So there are nuances to it.
Yeah.
Okay. There has to be some hidden jewel in that company that I like.
Okay.
And again, I'll give you an example of an infra play, which is A to Z.
Okay.
I mean, I don't like the infra business. We have been negative on it. I think we were at the top of the market 2007. I sold these companies. They were, I told the promoter of these companies that you guys are going to bust the way you're running your business.
Yeah.
All this order book nonsense. It's never going to work. Although, I was very early in 2003 also when I saw them really, really cheap at half-time book.
Right.
So the HCCs of the world. So actually, I rode the way up, but I saw towards the end of 2007 at the peak of the bull market, things were completely out of hand. And then obviously the collapse happened over the last 10 years. So that's not good enough reason just because something has collapsed that I have to go out and seek thrill in those names. There has to be something which is a lot beyond that, just simply debt. And, for instance, in A to Z, as I said, I don't like the infra business. I don't like the EPC business. I think it's a third-class business. It's impossible to make money in that on a sustainable basis because you're dealing with the government and nobody can make money off the government doing business legitimately. That's a simple belief. Okay.
Sure.
So the reason why we liked it was that embedded in their entire mess was their facility management, which does 300 crores of turnover and makes about 30 crores of profit. And if you were to put a 2020 PE to that, it's like 600 crores. The market cap of the company itself was some 240 crores, the aggregate company. Obviously, that's because of debt. So at least you have the germ of an idea or some daylight visible here that if they find a way, to get this debt to some extent reduced and then find a way to unlock this value, then we have something here.
I understand. So it's not purely a quantitative-driven approach. It's
no. Far from it. It's not a dumb computer model picking up things. That anybody can run a model and say stocks at 5-year lows. There's no rocket science.
And of course, that runs a risk of getting into value traps as well. So you're essentially saying you use your intellect to basically rule that out and look for a catalyst too.
100%. I mean, no, the computer model will only tell you that this is the range you should be focusing on. This is the basket, but then it is a lot of qualitative stuff. I mean, so it's not at all a computer-driven model.
Sure. So within that qualitative, can I ask you how much you give weight to the management? And you have been very vocal in saying, that good managements are always in hindsight. What exactly? What is your view when you're looking at management perspective from a company's perspective?
I mean, the only thing I will look for is in such situations. Remember, all managements which are hugging the bottom of the sector weights are all terrible managements. I mean, let's not sugarcoat it. I mean, obviously, there's a reason why they're there. There's a reason why they have debt equities of 2x, 5x, 10x.
Okay.
If they were that great, then they wouldn't be there. So they are branded terrible management. Good managements in bad sectors have a way of at least remaining solvent, sane and solvent. They may not be reporting big, high-popping numbers, but at least they won't be bankruptcy candidates.
Yeah, sure.
So, and it's like in a bear market, a good investor will lose like everybody else, but he's not going to go bust.
Sure.
Okay.
Yeah.
So, so the point I'm making is that all these managements are branded bad management, and there's a good reason for that. In that, the only judgment you need to make is that bad management tagged because of fraud, or is it because simply poor judgment? That is the call you need to make. Okay? Because remember, when you're buying such companies, you're going to be in bed with them for 3 years or 4 years or 5 years. It's not going to be a trade. You're not buying a Lazar at 2.
Right.
Okay. You're not buying a Tata Motors. So there you better be sure that whatever happened didn't happen because of malintent, or at least not a lot of it.
Okay.
So, and that's, after doing this for a long time, it's not that difficult to figure that out. 2 meetings, you will know that, look, there are reasons why this happened. They're stupid. He made mistakes, whatever, he went overboard, got carried away, by variety of advice. All that can be solved, but fraud cannot be solved. So fraud is a strict, no-go area.
Okay.
So coming to the next part, Mr. Sharma, what happens in such companies is if you have bought the right thing on the downside, being a cyclical, they may even make the same stupid mistakes again when the cycle turns. So how do you decide when to get out of such sectoral bets?
Oh, yeah. I mean, that's quite likely that they will make the same or similar mistakes.
Yeah.
You have to, and again, not very difficult. You start to see that they're talking nonsense again. And remember, you're engaging with them quite frequently. You meet with them, you sit and have a drink with them, and they'll start to again go grandiose and say that I'm bidding for this or I'm building that, and you're saying that what are the numbers behind it? Then they'll say, no, I know there's a lot of money. I mean, those are the kind of come on, it's not difficult to figure out. You will get a very, very clear sense that now this guy is going nuts again.
Sure. So just to again, just building on that, is his saying and his acting insane going to be a trigger enough for you to get out, or you're going to give the market the benefit of doubt because market can stay rational for a long period of time? So are you going to play that game?
We have no interest in the market. We have no interest in the market in such situation. Then it is really time to back you back. Very, very clear about it.
Okay, perfect.
So, like you mentioned, on the downside, you take, say, in 100 rupees, how much is the particular stock worth? So, at the top, do you have something similar to calculate? Like, they've come to a weight where it becomes impossible for them to continue anymore? Or some sort of that quantitative criteria?
Yes, absolutely. You can easily tell, again, the sector weight relative to the market weight. Okay, very, very good indicator. Okay, that it's contributing only X to profit, but it's contributing 3X to market cap of the entire market. There are many quantitative measures that we use, and they will almost inevitably tell you that if not fall, at least the sector will lose weight by sheer underperformance. So a sector may not fall, but at the very least it will lag. Lagging means others will do better. So in that case, in any case, you should switch out of the sector which is quantitatively telling you that now the weight of this sector cannot be higher. So, go back to tech of 2000, very, very clear that a group of 4-5 stocks was dominating the Sensex, weights. And you were saying that, can the Sensex therefore, simply be all tech and all other sectors put together will be like 20% and everything, and all these 4-5 companies will become like 80% of the, those are very clear indicators. So, it's not, again, while yes, you can exit a little too soon, but I have not found to be in hindsight to be that wrong that you exited and things kept going up and they became. Again, remember, I'm making one simple point. I'm not talking absolute stock prices. I'm talking weights.
Sure.
I'm only interested in weights. Stock prices in absolute sense have infinite capacity to go up. So let's not debate that. But the weight is bonded. It's bonded by 100%, which is a far easier call to make. It is a far easier call to make.
Sure. Besides sectoral weights, can you get us a few quantitative parameters you give high weightage to? I mean, I'm sure you look at many parameters, but there are few which stands out. So, any couple of more quantitative numbers you look at? Parameters?
I mean, to me, the mantra, the holy grail is weights.
Okay.
I mean, that in the quantitative thing, because valuation, again, you don't know 60p is right or 100p is right or 500p is right. Who the hell knows? I mean, we've seen tech trade in India from all the way from when they started 20x to they were trading at 600x at the peak. So you could have been wrong at every level. So I'm not interested in making absolute price or valuation calls. I'm only interested in making relative calls within an overall basket, which is bonded by 100% all the way. So that for me is the holy grail. That is for me the mantra. Okay, both on the ups. For instance, oil trade, very simple. Like I'll give you a simple example. When I turned bullish last year into $27, $28, the weight of oil in the overall commodity index basket was at a 25-year low. It had gone back to 91 levels.
Wow.
Okay. So I'm saying that can it lose more weight? I'm not saying can it lose more stock price. I'm saying can it lose more weight?
But what if it does? I mean, where do you draw the line?
Because it could. But what are the chances of something in an overall sort of bear market, but already in terms of the weight that it has occupied on a 25, 26-year basis, it has suddenly overnight gone from being at X to being at 0.5x, 0.05x in that sector in a matter of 1.5 years' time. Now, what are the chances that this remains there or goes lower versus it trades up higher? So, you can go from point.
No, fair enough. So you're putting the odds in your favor. That part is very, 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 very clear.
Highly.
Very clear. But what is the risk management? So let's say if it does go below, for example, let's say in 2008, you're looking at the index of the banks in US, okay, and it goes dramatically low and will be at all-time lows. At what point you will stake in, this is not working. Otherwise, there you end up becoming Bill Miller kind of situation where it just goes on down and you just keep on adding. So where do you draw the line? Is it a price-based line somewhere?
The only place where I don't make these calls are in banks.
Okay.
So a bank is nothing but a drop of gasoline on a hot tin roof. It has no assets. It has nothing. It is all up in the air.
Okay.
It has a tiny sliver of equity. That equity can evaporate in no time. So I'm not making value calls
Fair
or
enough.
That is a sector that can go to zero, by the way, and it did, right?
Fair enough. So I think the only risk management, you're doing it as a portfolio level, that you're not betting all the things there, but you're comfortable till the point your thesis plays out, and you're not betting on something which can go to zero, like banks.
Banks can go to zero, right? I mean, what is the meaning of book value? People say trading at half of book value, and therefore, what do you mean by book value in a bank?
True.
I mean, it is all a notional number. In an industrial, I know what a book value means, right? There is some substance to it.
True.
Right. Mr. Sharma, back in 2001, this is totally an unrelated topic now. You guys were able to sniff a rat in the financials of Worldcom. I mean, I know it's a way back, but can you refresh your memory and talk us through how your forensic research unearths the fraud?
I wish you had told me. I would have read up on what we wrote, but that's a long time back. I think there was a big disconnect in the capex and the depreciation numbers they were booking. There was some major disconnect and in fact we had asked them this on a conference call, and they had no answer for that. And I really don't recollect all the details, but I will, if I read up, I will know exactly what our thesis was. But it was pretty evident that something was very terribly wrong here, and but I don't know the exact details. It's just too far back.
Can you take us through your broad forensic framework which you follow for the companies, or key 4 or 5 points which you look for, or key 4 or 5 points which people generally miss?
Well, one of the the things, I mean, and again, in bad management, so-called bad management, people will always say it's cooking the books and all that. But, it's not that difficult to figure out where the cash is going. Unless, of course, it is a case like Satyam, where even the basic documents can't be relied on, which is an exception. But
Yeah.
If you just simply, fraud every single thing, then we ultimately have to find financial statements. I mean, if that itself is not reliable, then all bets are off. But otherwise, we have found, like there was a company, I will not take the name, but just a couple of years back, that somebody came to me and said that take a look at this company, it looks very interesting in India.
Yeah.
And so I said, yeah, but my impression is that it's quite a fraud management and all that. He said, okay, I mean that's the consensus, but why don't you do a ground up sort of view instead of just relying on everything? Yeah, that's fine. I have no problem with that. We did a lot of work. The things we found was that company had no capital issuance since 2002 or 2003.
Wow.
Okay. Now in India, it's very hard to find companies that have not raised capital in 13 years. Okay? Right. Barring the absolute blue chips and all that. Almost everybody raises every 2 years. Assuming the markets are permitting them. Okay. Now here's a company, last capital raised 13, 14 years back, and a mere 25 crore preferential. So I said that's a good sign. Second, debt used to be 500 crores, that has come down to 150 crores, good sign. Companies paying dividend, good sign. Companies paying 33% tax, good sign. At least all these elements which are pure cash flow driven. Okay, there's nothing accounting about paying taxes or paying dividends or reducing debt. I said, if this is there, then this guy is not a fraud boss. Okay, I mean, I'm very, very, very clear in my mind. After that, we did a lot of qualitative work. We went in, we met a lot of people, etc. The stock is up 3 times now in the last 2 years, 1.5 years time. Again, and then a lot of fund managers told me that, Shankar, I've heard you like this company. How come you like this guy? A total fraud company. I said, yeah, I mean, that's what I'd heard too. But have you guys done any work on this? And this I'm talking the marquee names of the Indian fund management industry. Sure. And not one guy had even bothered to do this basic 4 or 5 tests.
Financial checks.
And you just simply listen to people across a cocktail table and say that okay, this guy's a fraud, so forget about it. And this is so simple; it doesn't take any time. So just the basics are good enough for you to know. Okay, capex again, very, very good indicator.
Right.
What is the capex about? Does this business need capex? Again, that's a cash flow measure.
Right.
Okay. So these 5-6 things are enough for you. You don't have to become very exotic about it.
Sure.
That, as I said, history of capital raising is very, very important. That's like pretty much on the top of the list.
Sure. Can I just pick up on your experience a bit? I was, revising some financial shenanigans methods which the companies have used, and we have figured out over a period of time. One of the common cash flow shenanigans which many companies do outside, but I have not been able to find in India, is that companies take cash flow from investing or financing activities, and they take it back to operations. Any company in your mind which have done it?
You mean they've taken
cash flow from investing or financing activities, and they have taken it from there to put it into operating activities and increase their CFO number, visually?
I don't recall any company in India because usually you do have to categorize it reasonably accurately.
Yeah.
But what is done? Okay.
Yeah.
I'll give you another example of cooking the books. Okay. Which is that I buy a company with, let's say, 5 crore revenue. Okay. I buy it for 100 crores. Those 100 crores I inject into the company. So let's say I don't buy out anybody, but I acquire it via an injection of capital into that company. So the company becomes mine. All right?
Sure.
Right. Now the company got 100 crores of cash. That's on the balance sheet. And I rotate that cash via the P&L.
Okay.
So the company then suddenly, after I acquire, starts to declare good numbers. Okay.
True.
So, and remember, there are no receivables because the company's got the cash. The biggest problem is you can cook the books to an accounting angle, but you still have to get the cash in at some point. And most companies get caught out in the receivable cycle. That okay, you're running, one company in the education space in India, which was very popular a few years back. 6,000 crore market cap, and I have to tell all my fund manager, buddy, what the hell do you see this as a total fraud company? That is now, I think, almost down to zero. And again, 365-day receivables in the education business. And I asked a simple question: that how come you're collecting cash after a year? He said, that's a model. I said, boss, I studied in a school. I'm sure you have too. Usually we pay fees in advance. We don't pay fees a year later. I mean, which school,
Sure.
which school takes
Sure.
money a year after you study, right? That's bullshit. Okay. So, so the point is that you acquire a company, you pay 100 crore cash, that cash is in the bank, it's rotated via the balance sheet into the P&L. Suddenly the company starts to declare 5 crore profit. And,
Sure.
and everybody lauding you that, wow, what a deal, you turn around this company next year again, 15 crore profit. So suddenly now you increased your worth because that 100 crore lying with you prior to the acquisition was worth only 100 crores because it's cash in the bank, correct? So cash in the bank is equal to 1. All right?
Yeah.
But that cash transferred to another company and rotated back via P&L of now what is a 100% sub suddenly has a PE multiple of 15, 20, 50x. You see what I'm saying?
Sure.
Right.
That's a brilliant way. That's a brilliant way to increase your own market.
Another way is that you can ask the company not to declare any results, and when you merge it with yourself, declare all the results, good results.
Exactly. So here what you're doing is you got the cash in the bank. That's the first law of manipulation, that unless you have cash in the bank, don't try doing it, you'll be caught out. Here you got the cash. And now all you need to do is to keep booking revenues and show the cash coming in. He's showing collection, so there is no account receivable. The analyst is saying, brilliant. The guy runs with like a 15-day collection cycle. That's amazing, right?
True.
So,
that's where I think the understanding of business makes a large amount of difference. People who just want to look at the numbers, they get it wrong.
Correct. So in this case, in this kind of case, just looking at financial numbers or looking at just cash flow can be very misleading. I'm just giving you a contra example, of how this can be manipulated.
Mr. Sharma, on your website, I saw the first global quant system family. It says it's a multi-factor, multi-period, quantitative trading system that aims to be anti-consensus, anti-correlation in its approach. What is the underlying philosophy and the modus operandi of this?
As I told you, the central philosophy is the weights.
Okay.
And then, of course, it is married with momentum. It is married with, there are some valuation parameters in that too. Okay.
Right.
So those are overlays on top of what is the bedrock of this is really the weight.
Interesting.
Okay.
Yeah. And then you will add a few more layers to that.
Okay. And you guys are one of very few organizations who are not averse to combining fundamental analysis with quant. So in this, how does the screening happen? Do you filter based on fundamentals first and then look for quant inputs, or the other way around? Like the sector is in trouble.
Other way around. I think it's for weights and then I think the companies. Yeah.
Very interesting.
The other way around.
So, Shankar, so far, whatever we have talked about, it seems that, majority of your money you make by betting on betting on industries which are going to revive and going to make money in future, why is it that you have this image of Perma Bear on the street? I mean, is it because by nature you're skeptic and you always talk cautionary things in interviews, or you are a bear at heart and your interviews are timed only after the fall? What is it why have you that image? If you can just throw some light.
Well, they just call me when the market falls. That's not in my hands, unfortunately. So when the markets are rallying, they never call me. So, I can't tell them that you will call me now, right?
Okay, but how come this image came at the first place?
No, the image can be whatever it is, but the fact is that, by nature, I believe in caution, So I am not a evangelist for the stock market, and I have no intentions to be. Many people, a few people make a lot of money, but many people lose a lot of money. And I don't want to make it seem as if it's just a piece of cake and just walk in and make a lot of money.
Sure.
There is some skill involved, not a lot of skill, but there is still some skill. And more importantly, there's a lot of temperament involved in making money in the stock market. Not everybody has that. So I don't want to make it seem like a, let's play or a walk in the park, which obviously means that I usually caution people from going overboard in wild bull markets because those are the times when we'll make the big mistakes. But in reality, as I've said this in the past, that I've been outright bearish only twice, and which was really in 2000 and in 2007-8. Otherwise, I'm generally cautious, but I'm not bearish.
Okay.
And, in India in particular, if you are cautious, that means you're bearish. I mean, I think the equation is very, very clear.
Okay.
Or let's say if you're just going to be balanced,
Yeah.
you will be categorized as the bear. That balance equals bearishness. I don't think balance equals bearishness. Balance equals balance. I mean, you're saying that look, things look good, but these are a few things you must keep in mind. I mean, if that equates to bearishness, so be it. But outright bearish, I've actually been just pretty much twice.
So I think it's whoever is cherished is bull, and barring that, everybody else is a bear. Is that the case?
Correct. So I don't want to be a cheerleader. I mean, that's not what I get paid to do anyway.
So do you think as Indian investors, we are the most optimistic people around, or something like that?
I think, yeah. Actually, that's a fair point. I think we are very, very optimistic, sometimes excessively optimistic. And that, in fact, reflects in stock prices or other valuations as well. I mean, if you look at India as a particular market, nothing which is even halfway decent is ever cheap.
Right.
You will actually be forced to pay and overpay for moderately and good companies. That's not the case in many other markets, where
Sure.
you will find huge mispricings. In India, to see mispricing, you have to take a lot of risk.
Right.
I'll give you a simple example. There's a company called Aberdeen in London, okay, which is big investment manager.
Yeah.
Okay,
Yeah.
I mean, trading a dividend yield of 7% or 6%, something like that. Okay, the quality business. I mean, that kind of asset size, repetitive, replicable, every single quarter, barring, big sort of upheavals like 2008. The 7% dividend yield, you are borrowing at 1%, you're buying something at 7% dividend yield, and hopefully you'll get some growth. I mean, those opportunities in India, you will never, ever find. That money on the table today. You will find money on the table a year from now, but never, ever today. Very, very hard.
Or you find it in very, very troublesome sectors.
Yeah, but then that's not money on the table today. You have to go out on a limb. You have to take risk.
Right.
Yeah. Oh, very, very few times.
We live in a country where we cheer for opponents' white balls as well and would not clap for their fours.
Correct. I agree.
So coming to this point, in most of your interviews, you mentioned that nothing below a 30, 50, 100% return excites you, because you have a very strong fixed income portfolio wherein you get a high double-digit returns. So how does it make it difficult for you in Indian markets, and how do you get into the fixed income portfolio and make double-digit returns?
It's not high double-digit; it is double-digit. So just to be clear, so you can make 12%, 15% in fixed income, on a global basis. That's not difficult. Of course, there is leverage in it, but then if you're choosing well, you can make that. So, and that's in dollars. So, the equity hurdle rate therefore has to be substantially higher, and which is why I say that, in all these so-called troubled names, the last thing I want to do is to bet so much that that's going to affect the fixed income part of it, that I have to then draw down on fixed income and pay for the equity. That is absolutely a no-no. So the 50-100%, therefore, also in reverse tells me that I don't have to risk that much to make good money. As I said a while back, that if you're putting in a few crores, and you're looking at a 50-100% every year, you still end up with a substantial number at the end of a 2, 3, 4 year period. So in my method, I'm not risking big on a single trade. Let's just, in simplification, tell you that. Because the upside that I visualize is so much that, with even a small amount of money in absolute terms, I'll make like a lot of money if the trade works out right.
Mr. Sharma, I wanted to know, is there any future for short sellers in India? I mean, there are not many companies available in F&O, and besides the long-term options, the leaps is also not there.
Yeah.
Do you do any short selling, by the way?
Now I don't actually trade at all. So, over time, again, it's just a matter of your life cycle. So, the risk I could take when I was in my 30s, I definitely cannot take now. I just cannot even, I look back and believe that was the kind of risk we were running, 20 years back. Where a small 2-3% move in the market would be literally a huge amount of plus or minus on a daily basis. But that wall we cannot handle anymore. Simply not possible. And frankly, you should not be required to even do that anymore. I mean, that was the time when you could take risk and you wanted to take risk. You're happy taking risk. I don't take that risk. Also, trading is absolutely zero. But yes, when I was trading actively, shorting is very central to the entire method. Usually, we have run very balanced books. But in extremities, we run, higher shorts than longs, which was in 99, 2000. Definitely, I remember, we were vastly short.
Talk us through some of your big shots, the home runs that you might have hit.
I mean, home run was definitely tech in February 2000.
Okay.
And it was not so much a shot, it was more an exit of a long. So, I had missed actually the first part of the tech boom because I was a skeptic. So
Right.
the boom actually started in 96 in sort of a true sense, and Infosys, etc. used to be, 40, 50 times earning. I have to say, too bloody expensive. And remember, back then interest rates in India used to be quite high. You were talking like mid-teens to high teens kind of interest rates. In those scenarios, your multiple should not be more than, 5, 10 times on an aggregate basis for the market, with those kind of rates. And here we have a sector which is like, 40, 50 times earnings. So we were skeptical, and therefore we missed a reasonable part of, the initial part of the rally. And then, we found a clutch of companies, and which were really not great companies in hindsight. But, the markets loved them, so you had Himachal and you had Global and you had Penta Media and, and all that. And, like I always say that, I am agnostic on all these things. Many people in hindsight will never even admit to having bought these companies,
Sure.
But marquee names from FIIs, you name it, household mutual funds of the US, they bought 40% of these companies. So let's not pretend that, everybody was only buying Infosys and Wipro in the tech boom. So I'm very clear about it. As long as you can sell right, all companies which are trading legitimately, I have a right to buy. I have no problem with that. And so we got into them. Yeah, so we got into them and we made a lot of money. We made like 20, 30x, I think, in a matter of a year and a half time. And that is when I really got very worried, because I remember in February 2000, it was like all these stocks were running 8% up, limit up every day. And I just felt so uneasy that day. I remember, this is just too easy. Simply cannot last it.
Do you look at market valuations in general? Are the markets overall, how are the markets, besides the weight in the market, how do you see the overall market perspective?
Well, the valuation that time, all these names were 200 times earnings. So again, on valuation, on an absolute basis, it was stretched. But remember, they were coming from 50 times earnings. So there was nothing to say that why they can't become 600 times earnings or even 1,000 times earnings. So remember, that's, as I say, valuation, I don't believe in. I don't believe that valuation can give you, at very extremes, maybe that it works, but in the middle, there is a big range in which you can be completely wrong. So I don't pay too much attention to, to valuation ratio. So,
Sure.
I got uneasy and, I exited, and then obviously, then the stocks, fell quite a lot in February of 2000. I went off on a holiday. I came back after a month and everything was down 50%. Then when they rallied and I then met the companies and again reevaluated, I thought this game is over. This whole tech boom is over. And that's when the real shot was born, which was, I think, in March, April of 2000. And all these names collapsed, 50, 80%. In fact, I always used to joke that the commission we used to make on a single trade of these used to become, actually became the stock price.
Wow.
Used to make 1% commission, on all these on all these names, and they actually was the ultimate stock price of these companies after 2 years.
Yeah. Shankar, you recently mentioned about Twitter, and I was just, since you brought the question of valuations and all, I was just listening to your, reason which I mentioned there, and the company, I think X cash, it will be 9 billion market cap with 700 to 800 million cash flow from operations, and free cash, not operations.
Yeah.
So, but in that case, my question is that, relatively it's cheaper, it's fine. With respect to Flipkart or Snapchat, which you mentioned in your interview, it makes sense that, these companies with no profits, no free cash, they are traded at these valuations. So why should not Twitter be at this valuation? But if we see the absolute valuation, like Twitter will be 12 times cash, 12 times free cash. So do you take bets on a relative basis like this, or you're saying no, absolutely it's 12 times free cash, which is reasonable, that's why I'm taking the bet? What is the viewpoint here?
There's no relative here. I'm just putting the relative sort of other companies just to give a perspective, not to say that just because Flipkart is 15, then why Twitter should be 9 billion, because they're two completely different business and people can overpay for perceived growth in emerging markets by quite a lot, and which is what I think has happened in the Indian e-com space. But it's just that, and on a non-cap basis, Twitter is profitable actually. It's just the stock options which it's expensing out of that, which causes the so-called loss. But otherwise, it's actually a profitable company, and I think with $400-500 million of profit and $9-10 billion market cap, 20x for a tech company, or let's say a virtual company in that sense, is not expensive by any standards, even by capital raisings that happened in the private market in the US. Okay, where you have companies of virtually no revenues are now unicorns, $2, $3, $4, $5, $10 billion. So in that context, company generating cash, and it's a global marquee platform. So all things considered, I think it's a and return on equity, I think, is if you take about 10, 12%, 13% return on equity in an environment where interest rates are so low, so you see the sort of the differential between the ROE and the cost of capital. It's massive. So all things considered, I think it's a worthwhile bet to take. And again, street view has been very negative and all that. It fits the test. We'll see how it goes.
True. Okay. The market participants have been quite bullish on the government, the new government, and the activities that have been happening. And you are a data-driven guy. I just want to see it from your eyes. Do you see the data resonating with the positivity about the government, or there is something which you see a mismatch? What's your view?
No, I think, look, the street always gets paid to be positive. So I don't think we should pay too much attention to that. And I think by and large, and that's because the street derives income from being positive. So even if you and I became the prime minister, we would say I'm 100% sure we will still get positive press, or at least from the street, right? Because in a bear market or selling a bear market is not profitable. So let's ignore that for a minute. The only thing you should focus on is the data, and which has been the central thesis for me personally over the last 2.5 years, is that this government has nothing which I've seen as a big architecture or a big plan for the country. It has been largely piecemeal or largely borrowed from the previous government, and central to their whole sort of thing has been Aadhaar. Everything is coming out of that. So I see nothing which is setting them apart in terms of thinking or in terms of radical plan. Given that, and given the underlying data, which continues to be very soft, and given the fact that you talk to companies, and this is pre-demonetization also, things were very, very tepid. In that scenario, my view has been that large caps require genuine GDP growth, for them to grow earnings, whatever 15-odd%. And that's the other thing that I've always said. I've marveled, and I've said this publicly, that when your nominal GDP growth is 5-6%, how come analysts keep penciling in 15-20% in earnings growth? That's absurd, because ultimately earnings growth, which are always nominal, will mirror by and large, your nominal GDP growth. So if you go back, our nominal GDP growth used to be 12% or so. So earnings were around 12 to 15% kind of growth over the last 10 years. And last 2.5 years, because of inflation decline, we are now at 5-6% nominal GDP. And earnings growth, if you see last 2.5-3 years, that's between 0 and 5%. But beats me why analysts still keep talking about numbers of 15-20%. It's just a basic, contradiction. So my view has been large caps don't look good because we don't have enough firepower or tailwind to drive large caps up. But small micro caps have been on an absolute tear, and that's been, I said this 2.5 years back, that is the area where we're going to make a lot of money. And fortunately, the trade has worked out well. That's been just a tearaway sector, as an overall market sector.
So talking about analyst, and you've been a sell-side broker and an investment banker, what do you find is the best part and the worst part about that industry, or say what you faced?
Well, I'll tell you very honestly, being on the sell side, has a lot of positives, because for me, the biggest perk of being on the sell side has been that I've interacted with very many good minds. At the same time, I've interacted with a lot of idiots also. So, that it kind of balances out, but at least one has learned a lot by interacting with some very interesting minds globally on the buy side. So that's been a big perk. On the negative side, the biggest negative is that you cannot talk negative about any company or sector by and large. Very few people want you to tell them the reverse case from what they believe in. almost impossible. So if everybody is bullish, I remember in the 90s, Ranbaxy used to be, must-hold stock, or a Larsen and Toubro used to be a must-own stock. And when he did the numbers and he presented to them that, look, guys, these are all basically trash companies based on numbers. The story might be different, but the numbers don't add up. You would be thrown out of the offices from across the world. So, while actually, if you look at it in the 90s, Larsen and Toubro was an absolute miserable underperformer, and so was Ranbaxy. And same with Infra in 2007, when we said that this is going nowhere but down. Telecom, for instance, returned bearish in 2007. And I remember with a very marquee fund manager in New York, short of him slapping me, he did pretty much everything else when I told him that, look, telecom is an absolute short. This whole trade is over. So they don't want to hear something which is against their beliefs, and which I find very strange that, that's what you get paid to do, which is that keep an open mind. A closed mind is the biggest enemy to investing success. Single biggest enemy, a closed mind. And that's what I've found time and again in very many people. A handful of them will actually tell you, no, tell me that my belief is wrong. And I'll pick one name here, Madhu Kela. Absolutely open mind, willing to debate and challenge his own assumptions. Those are rare people. Otherwise, by and large, everybody wants to hear what they believe in.
Okay. So one more thing, you've been a proponent of market timing, and all through your interviews, etc., you always keep talking about how valuations are useless and timing is important. But when we come to the Indian industry, it's all about selling not to time the market, keep systematic investments, and even the structure of mutual funds here today does not allow timing, because you have to be invested 80% of the time. None of the fund managers take more than a 10-12% cash call. Is it business considerations, or do we believe anyways investors are taking a timing risk because none of the investors make money in a mutual fund as much as the mutual fund does? You don't want to complicate it by giving the timing skill to the fund managers. What are your thoughts on the whole thing?
I think in some part it is also sort of laziness, because if you just simply have a mandate to remain invested all the time, then that's one less problem to worry about. So you will not take a cash call. You by and large have 90-95% invested all the time. It's also convenient. It may not be always good, but it's reasonably convenient. That apart, the structure of the industry, asset management industry worldwide, is always about gathering assets. So I've always said this, that the business of a politician is to win elections. The business of an asset management company is to gather assets. Performance, etc., can be all secondary, and usually it is. So whether it's a politician or an asset management company, the one who's getting the most assets or winning is not necessarily the best guy managing money or the best politician. It's simply the guy who's marketing it best. So,
Sure.
Which is why, you find, because remember, performances can be manipulated in terms of what I want to show as performance. And most voters and mutual fund investors are fairly similar. In fact, nobody has got the bandwidth to analyze data that close. So whatever gets spoken loudly, gets believed. And, asset managers who are rich, who are large, who have the money to spend on advertising and voting will end up getting more assets simply because of that. And you can always massage the data to show good performance depending on what cutoff you take.
True. Shankar, how is your Cerebra investment doing and your interest in neuroscience?
No, it's not an investment. That is not about money. It is simply about, it is, that's something that, one wants to see where we can go with it in terms of helping people. It is not, in fact, not, why I say it's not about making money. There's a lot of other ways to make money than doing, neuroscience. It's a fascinating area, and that's an area where I think there's very, very little being done across the world. And if I can, as I've always said, if I can improve a few lives, that's great. You can find a doctor to do surgery on your body, but to fix a part of the brain which is not right is almost impossible. It just doesn't exist.
So besides the your contribution to the whole project, how do you how do you get involved in this whole project? In what kind of details?
I'm very, very involved in the sense that we have a lot of research going on. I personally spend a lot of time researching this. There's something I don't know, which I try to find out. It's a complicated business.
Sure. Sure.
But from where one was a few years back to where one is now, I mean, I dare say, oftentimes I find I know more than what a doctor does. Because I'm coming from an outsider's perspective. I have no preconceived notions. Doctors usually, because it inevitably is again a closed mind in a different field.
Sure. And any books you would want to recommend to us? I'm pretty sure you read a lot, and not market related. Anything.
Yeah, actually, I don't read market related books anymore. I don't know
Great.
when I read market, because I know that's a lot of it is and probably you know a lot more than what those guys are writing. So I don't read much of that anymore. But I mean, these days I'm focused more on understanding, a different aspect of business, which is social media, and because these are for some other investments we have, sort of more startup kind of things. So I'm more interested and more focused on those, or more interested in business models. Let's say a business model of a company like Zara, which I find absolutely fascinating. So those are the kinds of stuff that I'm reading, not really traditional investing or market related books. Reading books on IKEA, again, fascinating business model. Because the theme I'm trying to understand is this. Since 2008, the world has been plunged into a consumption crisis. But in that last 10 years, some companies have thrived remarkably globally. Okay, I'm just trying to understand what is driving those companies. Why are they winning business in the face of the worst consumption 10 years that we have seen in the last 100 years? So what's driving those? What business models do they have? How are they innovating? And Zara and IKEA are right up there in my list. So I'm trying to understand that.
Sure. Which will be the other companies in that list?
I'm still researching. I'll tell you when I have a list ready. I mean, Maruti is a very good example again. Closer home.
Sure.
I mean, I don't know of any country in the world where in a large industry somebody has a 50% market share. I mean, it's just an amazing number, and anybody in the auto business is there.
Yeah.
Yet, what was erstwhile a government company to have hung on to, in fact, they've gained market share in the last couple of years. It's just a remarkable story. Amazing.
Completely agree.
Mr. Sharma, one last question from my side. Can you recommend us some names that you think we should profile on a podcast?
And not the regular cheery ones, but even the unknown names. You think they are really good, and we should be profiling them.
Yes, I will send you guys a mail. Let me think of a list. There are many smart people. I think you should talk to them. But I will send you a list.
Great. It was a pleasure talking to you, sir. So thanks a lot for giving us some time.
No problem. Real pleasure, gentlemen. Anytime.
Thank you.
Thank you, sir.
Thank you.